Ning, today is Tuesday, October the 27th. We talked about taking a look at Zillow Group, ZG, and I told you that I would look at it the way I would look at a stock for the first time. So the first thing I want to do is see where the market is in general, and I look at the S&P 500 to do that. This is the chart of the S&P 500. So we've had this coronavirus drop. We've had this tremendous recovery, which exceeded the previous high. Let's draw a Fibonacci line on that one, which is called an extension. Wrong one. Let's take a Fibonacci and let's do a retracement from here down to here. And you can see that the market retraced. Here would have been a full recovery, 100%. Recovered to 114.6%. That's a minor Fibonacci area. The basis here is that the market trades based on patterns defined by the Fibonacci equations. You can look that up. It's from the 14th century, but it's remarkably accurate. So the next thing we want to look at is this wave here, which goes from here up to here, and see how much it's pulled back. It pulled back to the Fibonacci of 23.6. Again, another minor Fibonacci, but nonetheless, it came into play. Now we've gone up. We haven't quite reached a previous high, which is a bit of a warning for the market. It wasn't able to make a double top. It didn't have the strength to make a double top. It pulled back, and where is it resting? It's resting right here today, closed exactly on this line, which is the 50 moving average. Not a simple moving average, but what's called an extended moving average, which weights the more recent days more than the first days in the 50-day period, whereas this 50-day moving average treats all 50 days the same, just takes an average. This weights it and gives more weight in the equation to more recent days. Stop right on that 50. This is something else that market traders look for, which is gaps, which is areas where no trading took place. And gaps don't stay open forever. Markets come back and they test gaps. So if we lose the 50 tomorrow, if the market goes down, traders are going to say that it's going to go down to 33, this area here, right there, 33.36, which is the top of that gap. And if there's any desire to buy, that's where buyers will be. The other thing that I look at, and I'm not going to get into this too much, is a Japanese system which lays these mathematics on top of the chart. And you can see that we're coming down to the top of what is called a cloud, and where the market tends to get support. But it's a very thin portion of the cloud, so the support isn't very good. This is a forward-looking prediction of where the market could find support and resistance. And right now, there's not a lot of support that would prevent us from crashing down here and going to this gap area. So I'm optimistic about a bounce tomorrow because we're on the 50. But I'm also thinking we may go up to the 8 and then come back down through the cloud of low resistance and test this area. Another thing that I look for is called a McClellan indicator. The McClellan indicator simply tracks the market, the Dow advancers and decliners, the Dow advancers and decliners, not the 30, but all the stocks trading on the Dow Stock Exchange. And it says that once the McClellan oscillator reaches this point, this dotted line, the market is determined to be overbought. And it typically will pull back from that area. But you can see the enthusiasm that we had back in April for this massive recovery back here, right here. This massive recovery right here in April coincides with these number of times that the market went way above overbought. People just kept buying. Overbought, come down to the neutral line, way overbought, come back to the neutral line, way overbought, come back to the neutral line, overbought, go back to this line, which is oversold. The market hit this and responded to going way overbought and staying up there for a period of time. Anyways, long story short is we are now in the oversold area, and there's a high probability that when you're at the oversold area that you bounce. And you can see the number of times it's hit this line and moved up. Typically, it won't go very far below and it will come up. This was the COVID period. This is where we stayed well oversold for a long period of time, and buyers just didn't have a chance. Sellers kept pouring in. Fell below the line a little bit, then popped up, hit the line, popped up, hit the line, popped up, fell below, popped up, dropped below. Bottom line, we could be due for a bounce tomorrow because the S&P 500 has support on the 50, and the McClellan oscillator is showing that it's oversold. So let's now go to the stock that we're interested in, and let's look at Zillow. Zillow ZG. Not Zillow with Z, just plain Z. So let's just look at ZG. And where is ZG? ZG. There we go. So I thought Z was Zillow. Anyhow, they look very similar, but I'll look at ZG. So here's ZG. Took its big drop in COVID. Let's draw the same Fibonacci retracement on this drop. And let's see from the high to the low, where did we bounce to? Look at that. So this is a minor. I'm going to remove that one. This is a minor. I'm going to remove that one. Let's look at the others. Look at that. It stopped at 200%. That means that this Fibonacci and its pullback that goes with it is very important. We dropped below the 161.8. 61.8, if you look at Fibonacci theory, is called golden ratio. Forensic scientists use the golden ratio 61.8 to judge the height of a person if they only have their forearm, because there's a ratio, Fibonacci ratio between the length of the forearm and the height of the body. There's the seeds on a daisy are arranged in a spiraling pattern that goes out from the center based on Fibonacci lines, Fibonacci circles. It's really incredible science. Look, when we came back up, where did we stop? Just below 100%, came down to the 78.6, went up to the 100, stayed there, went up to the 138.2, came down to the 114.6. This green line shows it going up to the 150, pulling back to the 127.2, then blew all the way up to the 200. Now it's come down to the 161.8, but it's gone below that. It's been rejected at it. So I would say that ZG looks like it's still going to go down slightly. If we take the Fibonacci and we just look at analyzing from here to here, we can see that the pullback, let's take this one out of here now. Let's take this one out. This was our extension to see how high we would go. Now let's see how far we're going to pull back. Look at where we got support, 23.6. If you were going to buy Zillow, I wouldn't do it until at least it got higher than its highest today. And then you could step in and buy one call and wait to see if there's corresponding volume with that. But look at the volume down below. Not a lot of volume. There was buying here. There was institutional buying there because it's above this red line. It means it's not mom and pop that are buying the stock. But when it's below like this, below that average, it's people like you and me buying the stock, and Robin Hood traders buying the stock. It's not the institutions that tend to buy in big numbers. The last thing we would do to take a look at this and say, well, which one do we want to buy? As we take a look at Thinkorswim, and we look at the November option. Currently, the stock is trading at 91.55. So if we look at the 90 option, we're going to pay $8 for that. We only have 24 days until this option expires. So in 24 days, buying the 90 call, do we think we can finish higher than $98.7? Because it has to be above 98.7 for you to make any money. That would be where, right here at that Fibonacci line, where there's going to be resistance, because it was support. On its way down, it was support 1, 2, 3, 4 times, and then it became resistance. So when Zillow comes back to that area, not only is it near a round number like 100, where people will put in sell orders, I want to sell when it's at $100. It's very common for occasional traders like you and I to just use round numbers. So 98.99 coincides with where the price would have to be on November the 20th for you to make money. So let's say that you buy that. Let's look at the risk profile. The risk profile says if the stock goes up quickly, you could start making money tomorrow, because tomorrow's profitability line is the red one. Let's take a look at what the profitability line would be for this time Wednesday next week, the 21st. So if the stock was at $95 next week, one call would make $188 profit. If you hold on to it to expiry, you have to hold on, your price has to be above 98.98, because this blue line is the line of profitability or loss at expiration. As the days go by, this red line is going to start moving down and becoming closer to the blue line. I'll show you how that is as each day goes by. You can just see this line going down, meaning that you need to have a higher price to make money. So the November option doesn't seem like a good bet right now. There's too many things against it. Bring that back here. So now let's go and let's take a look at the December. You don't have weekly options for Zillow, you only have monthly options. Let's look at the monthly 90. That would be $10.60. If you buy that one, your risk profile looks like this. Let's get rid of our November one. So we're only looking at the December one now. Tomorrow, if you were to buy this call and pay $11.20 for it, you wouldn't make any money until the stock was above 95.93. Oops, sorry, that's not tomorrow. That's November the 12th. Let's go back to today. You wouldn't make any money tomorrow until the stock was at 93.57. What's the stock trading at now? What did we say? Stock is trading at 93.08. So you need to be trading above 93.56 to make any money tomorrow. So you can see, if you think the stock's going to go up in the short term, the December option doesn't look too bad. Although it's costing you $11, if the stock were to go up $5 in the next week, that would take this line from 93.08 up to 98. Let's say $5. Well, let's say it goes up to 96. And it's next week. I don't think I showed you the right date before. I was looking at this wrong. So anyhow, let's say next week is November the 3rd. Next week you would make $90 if the stock went up to $96. Is it worth spending $1,100 to make $96? I would say no. So then you look at out of the money options. So let's go back to simulated trades. Let's get rid of this one. And let's take a December one that takes the 105. This says that if you buy that call, you think that in the next 52 days, that stock has the possibility of going to 110.5. Your break-even point is going to be way out here at 110 something. However, let's go back to today. This is your daily profitability curve. This is where the stock is trading today. If it moves up to 96 tomorrow, you'll make $95. So you make $95 if it goes up tomorrow by buying the December 105 instead of the December 95 that we had before. You would have had to wait until next week to make that kind of money at that price. So you have to look at probabilities, become sort of proficient in this risk analysis chart. The other thing you look at when you're looking at these trades is open interest. If you were to buy the 90 December, nobody has bought that call, nobody. So why would you want to be the only one that buys it? If you look at the 105, only 17 people have bought it, meaning that if you try to sell that option in the future, there's only 17 other people who might be interested in buying your call. Not a lot of interest. It doesn't look like a lot of people trade options in this stock. Let's go out to other months. Let's go out to February. Now you can see the interest is in February, 1,260. People are willing to pay $80 for a stock that they think by February the 21st will be worth $100. That looks like a much better deal. Let's look at that risk profile now. So this says that on February the 21st, this is your break-even point right here, $100. This is your profitability curve for that option. If it goes up to $95 tomorrow, this option will make $86 for you. A cheaper option further out, making almost the same amount of money as if you bought a more expensive option further out. Zillow looks like a stock that could get to 100 but have trouble breaking through. So if you're buying an option in Zillow, you want to give yourself a lot of time. So you should be looking at the options that are out in January and February. Not a lot of interest in options in January. February, 80, 1,260 traders seem to like this one. There's nothing happening in May. Nobody's looking that far out. And these are called leaps, or these are long expiry option trades. And again, nobody is really involved in looking at too far ahead. If you want to buy options in Zillow, this is what you can do. Now, if you have a profit in Zillow, something else you can do is called selling calls. So let's say you have 500 shares. Let's keep it simple and say you have 100 shares. Let's look at a simulation. You said that you made about 30% on the stock. So let's simulate you buying the stock, and let's say that you paid $75 for it. You own the stock at $75. So right now, your risk profile says that the stock trading at 93.08, you've made $1,800 in profit. That may or may not be your case. You want to hold that profit, and if the stock pulls back, you want to benefit from that. So you could sell one call against your stock. Read up in the dummy book or on Investopia about what selling calls mean. Once you've sold a call, these 100 shares are used as collateral for somebody to let you sell something that you don't have. So the stock market is going to let you sell something. They're going to loan you a Zillow call, but you are going to deem to be having sold it. So you'll collect a premium for it. Let's take a look now at the December. Well, let's look at the November. The November 95 call sells for $6.20. So let's sell a November 26 call. You'll collect $620 in your bank account, but it will be tied to your 100 shares. You can't sell those 100 shares as long as you have a negative call. You would first have to buy back that call, then you could sell your shares. This is what your risk profile looks like now. It says that by the end of November, if the stock stays at $95 or goes to 95 and stays there, your maximum profit will be $2,620, which of course is your original $1,800 profit. Sorry, remember where it was? Which is your original $1,800 profit plus the $620. The stock goes above 95 on that expiry day at 4 o'clock in the afternoon. As soon as the market closes on November the 20th, they're going to come and they're going to take your 100 shares, but they're going to let you keep the $620 and they're going to give you $95 for each share. So that's sort of capping you on the upside, but giving you some protection. Because if the price goes down, as it very well could by looking at the chart, you still own your 100 shares, less profitable, but you're going to keep $620 worth of profit. So if the price on November the 20th is anywhere below $95, you get to keep $620 and then do it again in December and keep collecting premium like that. That's what I do. I own shares and I sell calls to collect premium on a weekly or a monthly basis against stock that I have long-term positive prospects on, and I don't want to sell them. I still want to be in the game with the stock, but I want to be collecting some money. I would never sell all my stock and go into just options. If you think the stock is going to go up, keep your stock. Don't go to risky something like options. Instead, look at selling premium. You could sell a December, which is further out, 110 for $3.30. Or you could sell a December 100 for $6.30. Now your profit at expiry for that same 100 shares would be $3,130. This blue line up here, and you can see the number is right down here in this corner. It's going to be $3,130. If the stock in December is not $100, you get to keep the $630. So I don't want to belabor that. If you want to get into selling calls, we can look at that a little bit more. I hope this helps you understand. I know it's a lot to absorb. Give me a call.